One fund choice in your retirement account can quietly cost you $260,000 over 30 years. That is roughly the price of a house. And here's the part nobody tells you. It is not the choice you think it is. The villain is not the target date fund itself. It is a specific hidden version of it that millions of people are parked in right now without ever choosing it. So here is the question we are actually answering today. Index funds versus target date funds. Which one actually wins over a 30-year horizon? A target date fund is the all-in-one option. You pick the year you retire, you buy one fund, and it automatically holds stocks and bonds for you and slowly shifts towards safer assets as you age. An index fund portfolio is the do-it-yourself route. You hold a few low-cost index funds and manage the mix yourself. The conventional wisdom says convenience always costs you. We pulled the data on fees on the glide path. That is the automatic shift from stocks to bonds and on investor behavior. And the honest answer surprised us because it cuts against both the lazy take and the snobby take. Quick note on our data. The glide path research and the behavior numbers come from authoritative sources like Morningstar. The expense ratios are industry figures that drift year to year, so treat them as illustrative. And every dollar projection here is a clearly labeled estimate. The framework is what matters, and the framework is timeless. Let us start by being fair. Let us compare a cheap index target date fund against a do-it-yourself index portfolio, apples to apples. Take a low-cost target date fund with an expense ratio of around 0.08%. Now build the same thing yourself with a 3-fund index portfolio. When you run the numbers, the return gap between the two is about 0.014% per year. That is 14 one-thousandths of 1%. That is not a gap. That is a rounding error. Over 30 years on a real portfolio, the difference is essentially noise. So let us kill the first myth right now. A cheap index target date fund is not robbing you. It is, for all practical purposes, the same low-cost portfolio you would build yourself, except someone else does the rebalancing for free. If that is what you own, the convenience is basically free. So where does the house go? Here is where it gets interesting. The $260,000 is real, but it does not come from target date funds as a category. It comes from expensive, actively managed target date funds. The kind that quietly sit as the default option inside a lot of workplace 401k plans. Watch what happens. Start with $100,000. Let it grow for 30 years at 6%. Now run it twice. First with a low fee of 0.25%, then with a high fee of 1.00%. That is the difference between a cheap index version and a pricey active version. The fee difference is only 0.75% per year. It feels tiny, but fee drag compounds against you the same way returns compound for you. Over 30 years, that gap silently pulls roughly $260,000 out of your final balance. Same starting money, same market, same length of time. The only difference is the fee. That is the house. And the cruel part is that the people paying it usually never picked that fund. They were defaulted into it and never looked at the expense ratio. Now here is the twist that flips the conventional wisdom on its head. You would assume the do-it-yourself index investor wins because they pay lower fees. But there is a second force in play, and it is bigger than fees. It is behavior. Morningstar runs a study every year called Mind the Gap. It measures the gap between the returns a fund earns and the returns investors actually capture after you account for buying high and panic selling low. Across all funds, the average investor gives up around 1.2 percentage points per year to bad timing. But target date and allocation funds have the smallest gap of any category, about 0.1 percentage point. Put those two bars side by side. The do-it-yourselfer leaks more than a full % a year to their own behavior. The target date investor barely leaks anything. Why? Because the fund is automated, it rebalances for you, it shifts for you, and crucially, it is boring. There's no single stock to panic sell, no tempting fund to chase. The automation quietly stops you from sabotaging yourself. So now let us net it all out, because we have two forces pulling in opposite directions. Start with the do-it-yourself portfolio. It saves you maybe 0.5% a year in fees versus a typical target date fund. That is a real plus. But then subtract the behavior gap. The average self-directed investor gives back around 1.1% more per year to bad timing than a target date investor does. Run the waterfall. You add 0.5% of fee savings on one side, then lose more than a full percent of behavior on the other. The net result tips toward the target date fund. For the average investor, the behavioral edge of automation more than pays for the slightly higher fee. Let that sink in. The convenient option, the one everyone assumes is the lazy and costly choice, actually comes out ahead for most people because it protects you from the most expensive person in your portfolio, which is you. This only flips when the fee gets extreme. A 1% active fund is too big a hole for behavior to fill. That is the line. So when does the do-it-yourself index portfolio genuinely win? 3 specific situations. Trap 1. The expensive active target date fund. If your plan's default charges anywhere near 1%, that is the $260,000 leak, and building it yourself with cheap index funds is the clear win. Trap 2. The taxable account. Target date funds are built for tax-sheltered accounts like an IRA or a 401k. In a regular taxable brokerage account, they can hand you surprise tax bills because the fund trades inside itself and you have no control over it. Vanguard actually paid a settlement of around $106 million tied to exactly this kind of unexpected tax surprise hitting ordinary investors. In a taxable account, holding index funds directly gives you control over when you realize gains. Trap 3. The glide path that does not match you. Every target date fund follows one preset path from stocks to bonds based only on your age. If that path is more conservative than you need, you can quietly give up growth for decades. Let us stay on that glide path, because there is a genuinely contrarian finding here. Every target date fund uses a declining equity glide path. You start heavy in stocks when you are young and steadily move into bonds as you approach retirement. It feels obviously correct. But research from retirement scholars, including work associated with Wade Pfau and Javier Estrada, found something counterintuitive. A rising equity glide path, where you actually hold more stocks as you move through early retirement, performed better in many scenarios than the standard declining one. It helps protect against the risk of a bad market right at the start of retirement. Draw the 2 lines. The standard target date path slopes down. The research-backed path, in many cases, slopes up. That is the exact opposite of what every off-the-shelf target date fund does. We are not telling you to bet your retirement on it. We are showing you that the one-size-fits-all path is a real assumption baked into the product, not a law of nature. There is one more mistake, and it is the most common way people accidentally break their target date fund. The whole point of the fund is that it is complete. One fund, fully diversified, done. But somewhere between 10 and 25% of plan participants who own a target date fund also bolt extra funds on top of it. They keep the target date fund and then add an S&P 500 fund or a bond fund on the side. Here is the problem. The moment you do that, you have thrown off the careful mix the fund was managing. We have seen people who thought they were making themselves safer actually push their allocation from something like 60% stocks all the way up to 80% stocks, because the extra stock fund they added swamped the bond portion inside the target date fund. They took on more risk while believing they took on less. If you own a target date fund, the instruction is simple. Own it by itself or do not own it at all. Mixing it with other funds quietly defeats the entire purpose. So let us turn all of this into a clean decision framework. First, check one number, the expense ratio of your target date fund. If it is low, somewhere around 0.10% or under, keep it. The convenience is essentially free, and the behavior protection is a real bonus. Hold it by itself and walk away. Second, if that expense ratio is high, up near 0.60% or 1%, that is your house leaking out. Build the same thing yourself with 2 or 3 cheap index funds, a total stock fund, a total international fund, and a bond fund, and rebalance once a year. Third, if the money is in a taxable brokerage account rather than an IRA or 401k, lean toward holding index funds directly so you control your own tax bill. Fourth, be honest about your own behavior. If you know you panic and sell when markets drop, The automation of a cheap target date fund is worth more to you than the small fee, because it stops the 1.2% behavior leak. And whichever you pick, never own a target date fund and then pile extra funds on top of it. Pick a lane and stay in it. If we just saved you from a $250,000 mistake, do us a favor and hit like and subscribe. We did the math so you don't have to.